Salve, cuidado hodie. Yep, that is starting off like the nerd that Tyler and I actually are. This is Hyperwave. I'm Leah Wald here with Tyler Jenks. And today Tyler is going to introduce a new system that he created for trading called Consensio, which is Latin. So in Latin, it means agreement, common accord. And he named this system 25 years ago from some simple observations, and he's used it for commodities, ETFs, and Tyler's realized that it also really works well for Bitcoin. So today, really exciting, similar to what we've done for Hyperwave, Tyler's going to begin to introduce the system very slowly so that you have a full depth of understanding about it. And at the very end, we're absolutely going to take a brief look at Bitcoin prices to bring everybody up to speed because it looks nasty out there. So, Tyler, Consensio.
Great. Thank you, Leah. And thank you, everyone, for tuning in and watching. As we've said, we've only been doing this for a little over a month now, and we've put out about 35 vlogs, many of which had to do with a system called Hyperwave. And some of you have found it to be very useful already. We've gotten a lot of communication back and forth about findings that you are making, and that's what we had intended all along. This is not for us to tell you when to buy and when to sell things using our systems. It's to teach you systems that we know you have not been shown before, and they may turn out to be very helpful to you compared with other things that you're using, or as a complement to other systems that you are confident with. And that's what we intend to do. So today, we are going to introduce the simplest of all systems using the simplest of all indicators. But it is a very powerful tool for visualizing movements in price. The reason we call it Consensio is, as Leah said, it means agreement or unanimity or common accord. And what we're going to look at is we're going to look at moving averages, but we're going to look at them in a different way than you've been exposed to before. This particular system we designed back in the 1980s and began using in the 1990s for very short-term trading in commodities and ETFs, being long or short. But I had been using it for 20 years before that to confirm my thoughts in terms of hyperwave and in terms of macroeconomic trends. So this is going to be a primer at the most basic level of what moving averages are. We're only going to use simple moving averages. We're not going to get into exponential, and that will become clear over the next 4 or 5 logs why we use simple. But what I'm asking you to do today is simply visualize what I'm talking about without worrying about all of the mathematics involved or the various relationships between the lines. And of course, to do that, I will pull up some charts, not many, just a couple. And let's try this one. That will work. And a number of you have been berating me about using Bitcoin wisdom. I have gotten the message, and I will be switching completely over to TradingView shortly. But I'm not going to do that until I'm very comfortable with it. And I am not at this point. I keep getting messed up. whereas Bitcoin wisdom is just unbelievably simple. There's not too many things you can do on it, and that's perfect for what I'm trying to achieve today. So what you are looking at are two wavy lines. They happen to be moving averages of Bitcoin. What you aren't looking at is the price of Bitcoin. You're only looking at two wavy lines. And one of the lines, which is the shorter term one, is 14 days long in terms of the calculation of the moving average. And the other one you're looking at is 52 periods long. Right now we're looking at a 6-hour chart. So a 14 period 6-hour chart is simply 14 bars, 6 hours each, that go into the calculation of the moving average. Now, I know all of our listeners and those that will view this later know how to calculate a moving average. For those who don't, it's very, very simple. To calculate a 10-day moving average, you need 10 periods to go by. Let's say those 10 periods, the price goes $2, $4, $6, $8, $10, all the way up to $20 in 10 days at $2 increments. You don't have any moving average. You don't have a 10-day moving average. You've only got 10 periods. You add those 10 periods together, you divide by 10, and that gives you a number. That's your first notation for the moving average, that first number based on the 10 periods in a row. Where do you put that? You put it under the 10th period. So the first 9 periods don't have anything. The first posting is under the 10th period. The next day, you drop the first period. You go to the 11th period. So now you add up 2 through 11 and divide by 10. And whatever that number is, you post it under the 11th day, and so on into the future, forever and ever and ever. On a 52-day or 52-week moving average, you can't post anything for 52 weeks. You need 52 weeks worth of data before you get your first post. Okay, what does it look like when you have two moving averages of price? For a second, I'm going to bring price up. I'm not going to use candlesticks. I'm going to use open, high, low, close bars. So what you're looking at is a short-term moving average, which is 14 periods. I'm now going to move to a daily, so we don't have to talk about weird periods. We are now looking at 14-day moving average and a 52-day moving average. The longer one, the blue one, is the 52-day. The yellowish orange, whatever that color, goldish is the shorter one, that's 14. Now I'm going to take the price off again, because you know what the price is. You've seen the chart over and over again about Bitcoin. But let's take the price away. And this, of course, is the run up to the peak. This is the drop to the bottom. And then this is the attempted recovery, and so far the failure of that recovery. Let's get rid of that, because everybody focuses on that, and there's no need to. You can focus simply on the moving averages. The reason it's called Consensio is we're looking for agreement. We're looking for unanimity. We're looking for common accord between these two lines. You can get these lines with all kinds of other price action that will look very similar. And you can get the same looking two lines with General Motors or IBM or Bitcoin or Litecoin or gold. But we're taking away all fundamentals at this point, including the fundamental of price. And why do we do that? Because what you see is in an uptrend, the short-term moving average is always above the long-term moving average. Period. In a downtrend, the short-term moving average is always beneath the long-term moving average. Now, that is true if the short-term moving average is 20 days and the long-term moving average is 21 days. But you won't be able to tell the difference. The bigger the difference between your time frames when using moving averages, the earlier it is you can see the movement. And there's all kinds of names for this movement that we're looking at, the death cross or the golden cross and all that sort of stuff. Forget all that. Just visualize what I'm talking about here without the price involved. The way moving averages move relative to each other. So, without knowing what this is that we're looking at, you've got a built-in trading system, which tells you as long as the short-term moving average is above the long-term moving average, you want to own this thing. When the short-term average is below the long-term moving average, you don't want to own this thing, whatever it is. You can go for very long periods of time where the short-term moving average stays above the long-term moving average, and simply by playing the cross, you get out and you get back in because you didn't know if this was going to go down to here, and you're not trying to use any fundamentals or other technicals at this point. You're simply looking at the two lines relative to each other. Okay. That's pretty simple. You can see you can go for months and months or even years without making any trades. And these are not particularly interesting moving averages to me. Everybody has to experiment. I'll give you ideas how I look at the length of a moving average depending on the type of an asset you're looking at. But for now, I just want you to pick up that one simple point. The second point is in an uptrend, both moving averages are moving up. Even when one goes down for a short period of time, in general, in a long-term uptrend, both averages are moving up. Well, look what has happened in this particular asset, which we happen to know as Bitcoin, beginning right here. We cut through the long-term moving average with the short-term average back in mid-January. Then the long-term moving average went flat and then began down. We said that in an uptrend, both moving averages are moving up. Therefore, in a downtrend, both moving averages are moving down. And it doesn't really matter if the short-term moving average goes up for a while and even crosses above the long-term moving average. The longer moving average is always the most powerful. That's the one you want to focus on. A long-term trend line is more powerful than a short-term trend line. Therefore, regardless of what a short-term moving average or a short-term trend line are doing, you want to override that from a risk-reward point of view with the longer term, always. Okay, enough of the general philosophy. Let's get into some individual important points using a series of charts. Here's the way these charts work. There's 13 of them. We'll go through them quickly. But this is really an exercise for everyone in terms of understanding the relationships of price, short-term and long-term moving averages over a full market cycle, meaning an uptrend in price, a downtrend in price, and an uptrend back to the original price. That's what I call a full market cycle if you're talking about an index or gold or Bitcoin. There are 13 movements that take place between this box and this box. And we're going to look at all 13 of them very closely. And what we're going to be examining are three variables: price, which is a blue line; short-term moving average, which down here is STMA; and a long-term moving average in red, which down here is LTMA. So our three variables are price, short-term moving average, long-term moving average, without designating length of time or period. So we're not talking 50-day or 200-day. This could be 1 second, 5 seconds, and 10 seconds. It could be 1 year, 3 years, and 5 years. Does not matter. The mathematics are exactly the same for all moving averages. Okay, I've got 13 subconditions. The first one I call A, and that is in this red box. The price is above the short-term moving average, which is above the long-term moving average. And by definition, all subcondition A's, which are called bull markets, whenever you see that configuration, price above short-term moving average, above long-term moving average, that's the definition of a bull market. Let's go to the next one. This is subcondition B. Now, see what we are doing here. What we are doing is taking all possibilities of the relationships between these three lines in what looks like a sine curve. And that's an important distinction. We will talk about that in later vlogs. This is the perfect situation that never occurs naturally. You'll get close to it a lot of times, but it's the starting point for understanding the concept. Condition B, look what has occurred. The price has become the same as the short-term moving average. In other words, price has gone flat or turned down so that it has become equal to the short-term moving average. The short-term moving average is still above the long-term, and the price is still above the long-term. Okay, that is condition B. Condition C, the short-term or the price continues down and is below the short-term moving average, and it's still above the long-term moving average, and the short-term moving average is above the long-term moving average. You can do this with pencil and paper. You'll see that this is exactly what happens when the constant price reacts with the variables short-term and long-term moving average, regardless of the length of time. Okay, let's go one step further. Are we in an uptrend or a downtrend here? Well, the price is in a downtrend. The long-term moving average is in an uptrend, and the short-term moving average is flattening out. You can just see that visually if you look closely. I apologize that it's a kind of a faint chart. And we'll try to correct that. Let's go to the next possible combination of these variables. Subcondition D. The price is now below the short-term moving average, but it's equal to the long-term moving average. In other words, it is now cutting down through the long-term moving average. But the short-term moving average is still above the long-term moving average. So what are we looking at here? We're looking at declining price flattening short-term moving average and rising long-term moving average. Remember what I said, the key is the long-term moving average because it's longer in periodicity than the shorter one. And it's still going up. So depending if you're a day trader, if you are an intermediate term trader, or if you're a long-term trader, you will use these various subconditions to make decisions. Let's look at the next one, E. Okay, what's happening here? Price is clearly below both moving averages. The short-term moving average is still above the long-term moving average. And what would you call this? Well, price is accelerating down. It's already turned the short term flat to down. The long term is still rising. Next, F. Price is below short term, price is below long term. Short term is now cutting back down through the long term. It's the same as the long term. There will come a point in time, maybe it's just a minute or an hour or a day or a week, in which those two moving averages have the same value. When you cut from bottom to top or top to bottom, there's a point at which they became a point and not two lines. All right, moving on. G, the most important of all. Why? It's the opposite of A. A was a bull market. You are now in a bear market. Why? Price is below the short-term moving average, and the short-term moving average is below the long-term moving average, and most importantly, they are all moving down, as opposed to A, where they are all moving up. So to get from an up market to a down market, you need to go through steps B, C, D, E, and F in that order to get to G, which is a change in direction of the market. And then at some point, you will go through another series, H, where the price begins moving up, I, where it cuts through the short-term moving average and the long-term moving average, J, where price is above the short-term, price is the same as the long-term, short-term is still below the long-term, etc., all the way to M, number 13, where the transition is complete once again. Okay, enough of that. Play around with pencil and paper and see if you agree with this. It seems very simple. It actually took 6 months with 3 people working every day, 2 interns and myself, to understand that movement. And then use it on every possible stock, commodity, everything else. It becomes very clear in a short period of time that that's the only way you can go from an up to a down move. And why is that important? It's important because instead of guessing in terms of RSIs and stochastics and momentum indicators, this is real-time sequential mathematical movement between these two very interesting lines, a short-term and a long-term, and they are completely dependent on price. Even though you don't see the price, they are completely dependent on it. That's enough for the beginning understanding of Consensio. I will give you a problem because Consensio is not made up of 2 moving averages, it's made up of 3, a short, an intermediate, and a long term. And my question to you, for those of you who want to spend a couple of hours or months figuring it out, is what is the interrelationship between 3 moving averages as variables against price? How many variations are there? We've seen 13 with 2 lines in price. How many are there if you add a third line? And I will reveal that at a certain point, but I'd like people to think about it, because the process of thinking about it gets you in more attuned to what we are trying to accomplish with the system. Then we'll go into the rules and the length of time and the periodicity and the height above a mean and all that sort of thing, which you will need to do to use this at some point in the future. You don't need to do all of that stuff. You can simply look at these 2 lines, get rid of price, and you can make some excellent decisions. We've been getting a bunch of questions with people that are getting frustrated with the Bitcoin market, because every time they use a bunch of systems, they end up losing their rear ends and can't figure out why. I think this tool will help as either a very short term or an intermediate or long term way of settling your mind about what's really going on with the underlying asset. Okay, we want to talk about Bitcoin prices. So what I'm going to do is I'm going to remove these. I am going to add these, and we are going to look at Bitcoin prices. Okay, we are in a downtrend from 19,666, and we still are in that downtrend. We are in an uptrend from 10 years ago. The uptrend and the downtrend both together have created a hyperwave. The hyperwave has its 3rd phase wave come in at 8,096. Let's call it 8,100. We keep getting very close to that number 3 times on a daily chart in the last week. 8,500, 8,400. Today we've dropped down to as low as 8,201. I've explained that I believe that means that we are in for support 100 points lower from here. That does not mean that that support 100 points lower from here is going to occur today or tomorrow or the next day or the next day, but it must occur before Sunday at 8 o'clock. We must close above 8,100 by Sunday at 8 o'clock Eastern Standard Time. Otherwise, the 3rd phase has been invalidated, and we will drop down to the phase 2 line, which I've also explained is coming in around 4,100. We will get a more precise reading on that. And then we have to speculate, will that break or will it not break? And the market will tell us, just as this market is telling us that it does not want to go up above 10,100 as much as it wants to go down below 8,400. And it's telling us that because every day we're getting more information. It's fairly impressive that at various times we get 5 or 6 days of consolidation, but almost every time we've been getting these 5 or 6 days of consolidation, we break down to the downside. We are still in a short-term uptrend from this bottom at 5,900. I don't believe there's anything important about that bottom. What I mean is, I don't think it is nearly as important as 8,100, because 8,100, when broken, will take us right through 5,920 down to 4,000. Yes, we might get a bounce at 5,900, but as Tone Vase likes to say, all we have done for ourselves by bouncing off 5,900 is prolonged the inevitable. What is the inevitable? Breaking down a double bottom. And I agree with that. So where we are right now is we are still hanging by our fingernails above the third phase trend line, which I will draw in so we know exactly what we're talking about, and I'll show you what points I'm using to draw it. I'm using this bottom, which occurred on July the 9th of last year, and I'm connecting that to this doji because the close on that doji is slightly lower than the close on the previous red candle. And by drawing it in there, we cut, even though we cut the bottom of this green candle off, that doesn't matter because we're only interested in weekly closes, not on what goes on interweek. Same thing here, same thing here. And importantly, same thing here. This is the key to where we are right now, which occurred on February the 4th, where we dropped all the way down to 5,900, and depending on what index you were looking at, 5,920 on Bitstamp, a little bit higher or lower on other exchanges. I don't really care about all that. What I do care about is where did it close on all the exchanges. And clearly, after breaking sharply below the trend line, which at the time was coming in around 7,200, we dropped all the way down to 5,900 without invalidating the hyperwave. So that brings us to this point. And at this point, where we are within 100 points, give or take, of the hyperwave line, and we're sitting here on a Wednesday, we could easily break it down, and various other analysts are saying they could have targets of around 7,500, short-term targets. That would be fine. I would like, if we do break interweek below this line, that we don't go lower than 5,900. And we don't come down to 5,900. I would like to see something, if we do break, and hopefully we won't, but if we do, between 7,000 and 7,500 is the low. And then on the following day, the following day, the following day, start erasing those losses to close back above the trend line. To me, that would be perfect. It would simply be another touch point like this one, this one, this one, this one, and this one along this line. I also think that that would be a rallying call for the bulls to, again, at least put in another 4 or 5 weeks of upside action. And hopefully that would be enough to blow through the trend line from the top in such a way that we could clear all that resistance that we talked about before. And here, very briefly, because we're going on too long again, is that chart of what I call the valley of death above the price. It's just monumental. There's just too much to get above. And one thing about getting a running start at the barriers, particularly after having fought off this negativity that we've seen for the last 5 days, if we can bounce off of this phase 3 line and then go sideways, get back above the downtrend line, and then start picking these off. As I said a couple of days ago incorrectly, I thought we had the potential up here to blow through 10,100 and 11,100. I think that's what we're going to need to do. I don't think we can tiptoe through this minefield. I think we're going to have to get a running start and just run like heck and blow through as much of it as we can before we take a rest. Too much information, sorry, but I thought it was good to tie all this together. And welcome to Consensio. Now you've got a couple of things to think about, Consensio and Hyperwave. I will try to spend equal time on both of them, but there's a lot of learning before us in terms of Consensio. And with that, thank you for listening, and I'm going back to Leah.
Thank you, everyone. Hopefully it made a little bit more sense to you than to my dog Thor over here. We're definitely going to start rolling this out little by little. So it should make sense and everybody should have a very deep understanding by the end of it, in the same way that you guys seem to understand Hyperwave with your brilliant questions. So again, thank you for watching. Hopefully, Bitcoin prices won't look as nasty as they have been, but we'll keep watching, as I'm sure you guys will as well. And good luck trading.
Great. Thank you. Goodbye.
Have a great day.